Don't break the bank. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installment in our quote series, we're going to evaluate the saying of don't break the bank, and we're going to do it with an infinite banking lens. So it seems that this is a French saying from as early as the 1600s, but in 1873 there was a famous, very massive winning at the Casino De Monte Carlo, and the breaking of the bank essentially was that this individual had won so much that the bank was scrounging to round up the actual amount that this gambler had won. So that's the origin on the saying. Very interesting. Now, at the time of this recording, 2023, this is a year where we have very noticeably heard about several banks closing. Now, I would just like us to all maybe think big picture for a moment, and then we're going to dial in on banking at the me and you level. So big picture, real quick. It's worthy to ask, have banks failed before? Yes, they have. Perhaps in history, you would perhaps think of the Great Depression like I would when you think about runs on the banks. And there were thousands of banks that closed during the Great Depression. Okay, so let's go to R. Nelson Nash's book, Becoming Your Own Banker. Again, just thinking big picture here about breaking banks. This saying came, from this particular example, but what else have we seen in history? Well, one of Nash's prime examples about being an honest banker, one of his principles, be an honest banker, is to refer to capitalizing. There are lots of his principles that we can notice and we can glean and we can apply to the First National Bank of Midland, Texas. At that time, he talks about what a well-known bank it was, what a high income earning area per capita that area was. So very big bank. It went bankrupt, and he talks about how there was not enough capital kept on hand. The owners of that bank did not keep a correct ratio between debts that they had on the books, capital, etc. So all that to say, big bank failed due to poor practices. So banks in the Great Depression failed in masses. In Nash's book, much more recent history, big banks failing. 2023, time of this recording, big banks failing. So the big question then is it possible to break the bank? Yes. I know so that's big picture. And I think it's worthwhile evaluating. Folks, where do you warehouse your capital? Now, I know some of you are saying, well, Jesse, mine's under the mattress, or mine's out in the hole in the yard, or mine's in the coffee can, or whatever, right? And then so many of us, though, are just having our deposits directed immediately to the bank. I mean, we earn every week or every other week, and it's just directly deposited into somebody else's business. I'm just saying that's worth answering for yourself, considering for yourself. Where do you warehouse your wealth? Okay. How safe is that? And I know there are going to be folks, they'll jump up in the comments, FDIC this. Okay. What are you going to say to the folks that had their bank closed in the Great Depression? What are you going to say to the folks that had money in some of the banks that have gone under here in 2023? And again, I understand 250,000 above and below and those differences. I'm saying at the macro level, has it happened that the banks have broken? The answer is yes. Is it possible for it to happen again? The answer is yes. Okay. No, so before we go away from this macro level, let me put this out there. Here's one stark difference. And I was having a discussion with someone just this week about the differences between using banks, bank loans, and using insurance companies and insurance loans. And at the end of the day, I'm encouraging everybody to be your own banker. If you maintain control over the banking function in your life by still using banks, that's your prerogative. I'm not here to tell you to do one or the other. I'll point some things out, I believe. Okay. So differences between banks and insurance companies. Have there been runs on banks and banks failed? Yes. Have you ever heard of a run on an insurance company? Have you? Me either. Okay, there's a reason. So what I'd like to point out here, and of course, again, the detractors are going to jump right in here and say, well, no, this company has gone out of business, or this company has gone. There's a very big difference. And let me give you two right offhand. Number one, if an insurance company, through poor management, what have you, whatever the reason is, does become insolvent, okay, there are recourses, and in fact, it's by law. So essentially, if it's not able to be remedied, the issue with that particular company, the other insurance companies within that state have to buy the other one out. Essentially, they have to make good on the promises of the death benefit, etc., for that insurance company. Okay, so there's right off the bat, right out of the gate, a very stark difference between, and no FDIC involved. Okay. By law, the others have to buy out that particular insurance company. And then here's another one. We all know that banks are lending out more money than what they have. That's one of the things at the root of the problems that the First National Bank, Midland, Texas experienced, that Nash talks about in his book. Banks in the Great Depression, banks here in 2023. Okay, that's a big part of the problem. Insurance companies, however, do not lend out via policy loans and investments that they make, do not lend out multiples of what they have received in premiums or what they have on hand. So banks are lending out multiples of what they have received in deposits or what they have as reserve capital. They are. Maybe it's 9 times, maybe it's 19 times. Who knows? There used to be this whole 10-to-1 ratio. It's not that anymore. So they're literally just printing digits on a screen. The money that banks are loaning out did not exist until someone signed that loan agreement. Okay, whereas insurance company are loaning and making investments for money they have. They've got it. They're not loaning out multiples. So there are some big macro level differences between banks and mutual life insurance companies. So, and again, mutual life insurance companies are the ones that we prefer for implementing the infinite banking concept, because as a policy owner, you are literally part owner of that company. You can enjoy dividends. And furthermore, just to throw some history out there, there are multiple mutual life insurance companies that have paid dividends. So not only have they met all their financial obligations and they're A-rated and all these different things, but they've paid a dividend for 100 consecutive years. So again, think about all the history that I've just alluded to, okay? All these other different bank failures. Think about stuff like the Great Depression, stuff like World War I, the Great War, okay? The Vietnam conflict, the dot-com bubble, the housing crisis, 2008, all the different things that have happened over the past 100 plus years. And these companies have met all their obligations and provided a dividend to policy owners, to the owners of the company. Big differences, folks. Big differences. Now, I know that in my life, I've heard this saying on a very local level, okay, at a very me and you level, where someone will just say, well, I'm looking for a such and such. It could be a guitar for the child. It could be for a car. It could, whatever it is. Well, I'm looking for a such and such, but I don't want to break the bank. Well, at the me and you level, I know exactly what you're saying. You want something reasonable. You don't want to pay too much for something. And in fact, it's got to be something that's in your budget, whatever that happens to be. Okay. So anybody at any level of finance could say that. Okay. And you let me know down in the comments section if you've heard this saying or use this saying, don't break the bank. You know, I want to do this, but I don't want to break the bank. I need this. I don't want to break the bank. Let me know down in the comments section if you've seen, heard, used that comment, that saying. So here's where I'm going to point us back to the principles for a solid financial foundation. And that's going to be considering what Nash says about Parkinson's law. We all have to address Parkinson's law. See, most people are spending more than they make. I've been there. I've done it. Spend all that I make. Okay. Yes, that makes me make me laugh and smile there for a second. So, and you think about your blunders too, right? So it's just that way. That's the natural human tendency, is that we tend to spend. That's going to make a funny blooper right there. Okay, so let's start all over. Parkinson's law states that we tend to spend all that we earn. We have to address that. If we do not address that, we will break our microbank. We will break our financial standing. We will not progress. We will not succeed financially speaking. Okay, we have to address Parkinson's. Another is the golden rule. He who has the gold makes the rules. We're told to put all of our money in all these sundry places where it's locked up for the next 20, 30, 40 years, can't touch it, and we could have a hardship come. I talk with folks all the time. They have some financial hardship come, and they're trying to get a hold of the 401k money or the whatever else, right? They're trying to get access to capital. But see, he who has the gold makes the rules. Okay? If you don't have access to capital, you're going to have a hard time dealing with those financial hardships. Also, opportunities. What if you have an opportunity show up and you don't have ready access to capital, okay, to be able to move on something quickly? Okay, so Parkinson's law, the golden rule. I'd throw in Murphy's law. That's not one of Nash's, but it exists. Murphy's law is, okay, if something could go wrong, it will go wrong. That maybe kind of goes along with financial hardships, right? There is, these principles of thinking long range, not being afraid to capitalize, being an honest banker. You don't want to break the bank? Be an honest banker. Okay, are you more likely to break the bank if you're being dishonest? Okay. So not giving your money a true cost of capital is an issue. And again, we're past Parkinson's law at this point, but not giving your own capital a true market value as an honest banker. If you make a loan from a bank, don't you pay it back plus interest? Okay. Well, for those that are vetting, those that are researching, and for those that have already implemented infinite banking, and I've got these clients, I've got these folks that they've got a policy and they've not done anything with it yet, which is fine. It's great to be well capitalized. Again, for hardships, opportunities, they're both going to come. But what I'm saying is if you don't want to break the bank and you're vetting or even already implementing infinite banking, when you do make a policy loan, pay that back plus interest, a true market rate. Be an honest banker. Give an honest market value to your capital, because it's just going to put you better positioned for the next time that you need or want access to capital. You're just going to be expanding the system that you have. So Nash has more principles. I'm going to encourage you to check out the book, Becoming Your Own Banker by R. Nelson Nash, to get a full look at all of his principles and precepts for implementing infinite banking. Of course, I'd encourage you to check out more on our channel if you're wanting to learn more. But if you'd like to have a conversation about how to implement infinite banking into your household or your business or your investing, then don't hesitate to reach out to me. You can get in my calendar. You can watch my free presentation, all from our website, durhamtalents.com. And this has been a great pleasure for me. I hope you have a great day. Take care. So are you trying to tell me that the saying of "don't break the bank" came from a gambling example? Tell me more.